With U.S. China trade tensions rattling investors around the world, Chinese investment in the United States is all but stopped. And a new report from the National Committee on U.S. China Relations and the Rhodium Group also says the U.S. firms operating in China plan on downsizing. Our correspondent John Terrett asked Committee President Stephen Orlins what he thinks is the main takeaway from this report.
Chinese investment into the United States has fallen off a cliff, that it's dropped from, tens of billions of dollars several years ago to virtually zero. It's actually contraction now, that if you include the sales of Chinese assets in the United States and add back in the investments, you still don't reach zero. You actually end up still somewhat below zero. And that's bad. It's bad for U.S.-China economic relations. It's also bad for the American people. I still remember vividly going to the home of my brother, Dayton, Ohio, where Fuyao Glass had built a new facility in an abandoned General Motors facility. So think about that General Motors, this great American company, had laid people off. And then what happened is this Chinese company brought the people back to work. 2,500 American families are fed because of this Chinese investment. So I always look at these numbers, this data, and I bring it kind of down to the everyday level, which is, what does it mean for American families? What does it mean for feeding your family? And I think it's not good that we've overreacted to kind of the China threat. And we've determined that Chinese investment is not good. In certain industries, we certainly should not have Chinese investment. We should not have it in defense-related industries. That's perfectly rational. But to see it drop down to zero, now the Chinese government is also responsible for this, that the capital controls that China has put on, the difficulty for Chinese companies and Chinese individuals to get dollars out of China and invest them in the United States has also been responsible for this drop. But ultimately, kind of investment is a ballast for good relations. If I sell something to you or you buy something from me, you do it and then you kind of go home. But when you invest, it's like you get married. You got to stay there. You got to make it work. You got to build a relationship with your workers, build a relationship with the managers, and it becomes a way of building constructive relations. So not only does it have positive economic effects, it has positive people-to-people effects. So when I read the report, when I looked at that data, it actually made me sad. And I kept thinking of ways, how can we bring it back? How can we get Chinese to invest more in the United States? How can we increase American investment into China?
So, Stephen, I want to be absolutely clear. The report is saying that Chinese investment in the US has dropped to near zero in the last 6 months, whereas US investment in China has more or less stayed the same. But don't you have to see that within the context of the size of the two economies?
In terms of the size of the two economies, the amount of bilateral investment is actually tiny. It should be 10 times the amount that it was formerly. So now that it's dropped up to virtually zero, it constitutes, less than 0.1% of both economies. So U.S. investment, as China opens in the coming years, it opens financial services, as it reduces the requirements that ends caps on U.S. investment, what we'll see is U.S. investment in China growing. What we should see, what both countries should see in order to kind of capture that potential, is a bilateral investment treaty. That what we should have is a treaty that allows U.S. companies to operate in China fairly and allow Chinese companies to operate in the United States fairly. Then we would see an enormous ratcheting up of investment from both sides, which would be good for both economies and for both peoples.
And yet the report says that US firms that are based in China, like Dell and HP and Intel and Google and Amazon, are thinking of downsizing there. Why would they do that?
Each of those companies have different issues. Google's issue is it hasn't, for the last 12 years, been allowed to operate in China. What the Chinese government should do is open to Google. The Chinese government has claimed that it's a national security issue for them, but they are perfectly capable of blocking individual searches and allowing Google to operate. If they did, then the number of Google employees in China would quadruple, quintuple, be 10 times as many, and it would be good for China, it would be good for Google, and it would be good for U.S. China relations. Companies that use China as an export base back to the United States are reconsidering what they're doing because of these tariffs.
We have seen companies pulling out of China, though, we're told, and going to places like Vietnam and Malaysia and looking even at South America. What kind of companies have been doing that?
Ones which are affected by the U.S. tariffs. So it really is a tariff issue. And ultimately, what would have happened what's happened is the tariffs have increased an exodus from China. That Chinese costs, Chinese labor costs and other costs were increasing. And what would have happened over the next 10 years is the lower value-added manufacturing facilities would have slowly emigrated out of China to Vietnam, to South America, to lower cost labor destinations. What the tariffs have done is says, it ain't gonna be 10 years. You better do it today or tomorrow, because you immediately have experienced a 10 or a 25% increase in your costs as a result of the tariffs. And that's what we're seeing. We're seeing a migration of those businesses out of China.
Where on the economic grand scale of things does a report like this sit? Does it influence trade policy just by its publication, or does trade policy have to alter before some of the things that you talk about in the report can come true?
It's backward looking. The report gives the data for the last year. It's not forward looking. What it should be is a wake-up call to the Department of Commerce, the Department of Treasury, the National Security Council, that the American employment is being damaged by these policies that restrict investment. On the Chinese side, it should be telling the Chinese government we need to open more. That $10–12 billion of American investment in China is tiny, and we need to reaffirm China's commitment to being an open investment environment. Because when it is, that number won't be 10 or 20, it'll be 50, $100 billion, because that would be the equivalent of what should be happening in the Chinese economy in terms of American investment.